Hello learners. This video is aimed at those individuals who would like to get a comprehensive quantitative approach towards futures trading. The course caters to both beginners and veterans who wish to use math and technology in futures trading. Before we delve into the course details, let us first understand why futures exist in the first place. You know that the prices of different materials fluctuate regularly. Crude oil prices have been known to range from $40 to $80 in the past decade. At one point, oil prices touched $100 per barrel. In this scenario, a company that depends on oil to power their industry might incur losses if the prices increase suddenly. What can the company do to avoid this uncertainty? They can enter into a deal with the oil supplier, where they agree to buy a specific quantity at a specific price. That is all when it comes to futures. They are entering into an agreement to buy, or sell, a commodity in the future, at a price which is fixed today. A future is one such agreement. Here, you should know that broadly speaking there are two types of people in the futures market. One part consists of consumers and producers who actually buy or sell the commodity. The other part consists of speculators in the market. A speculator is someone who is not interested in the physical delivery, but wants to gain from the price movements in the futures market. Let's say that you have analyzed the gold market and know that in a few months, it is going to increase. Now you can buy a gold ETF and wait till the price increases. Or buy gold futures right now on margin and sell it later. How many futures do you think are available for trading? A lot. The main advantage of futures is that you have so many options to diversify your strategy. Diversification also helps minimize your risk while maximizing your reward. The fact that you can buy futures of uncorrelated assets makes futures trading compelling. What kind of strategies will you learn in this course? You are going to learn one of the most effective strategies in futures, the trend following strategy. While it might not be as effective in single markets, it could give you impressive returns if you diversify your investments. You will also learn about the counter-trend or mean reversion strategy. Another strategy which is unique to the futures is the term structure-based trading strategy. Knowing these three strategies will give you a unique insight into trading futures. We will of course compare our strategy with the index to see if it is worth trading or not. But why do you need to know Python and analytics for trading futures? Simply put, to make sure your strategy is really good. You would not invest a significant portion on an idea whose effectiveness is not known. This would be similar to taking a guess. This is why you need to backtest your strategy with decades of data and see how well it performs. In this course, you will calculate metrics like Sharpe ratio, annualized return, maximum drawdown. This will help you assess your strategy's performance. Depending on the result, you can choose which strategy you should go forward with. This is just an example of how one of the discussed futures trading strategies performed in comparison to the S&P 500 index. The blue line indicates our strategy's cumulative returns while the orange line indicates the S&P 500 index returns. The goal of this course is not to give you a ready-made strategy that you can deploy in the live markets. Instead, you will learn how the futures market performs and build your own unique strategy. You can then backtest and paper trade it to see how it performs in the live markets. And if you find the performance satisfactory, you can choose to deploy it in live markets. This course will assist you in all steps of the process, not just the theory part. We hope you enjoy the course.